Hi, welcome to part 2 of the Market and Economic Summary. In part 1, I spoke about market valuations and the implications for returns over the next 10 to 12 years. The problem with valuations is that it's not reliable at all for short-term timing decisions. Markets can remain extremely overvalued or undervalued for much longer than we'd expect. However, there are some metrics I've been following that may provide a better insight into where we are within the market and economic cycle and give us a better sense of timing. I'm going to go through this presentation pretty quickly because there's a lot to cover, so I'm going to speak fast and fly through the slides. The nice thing about video is that you can pause, so if you need to, feel free to pause and review whatever charts you'd like to review. So on with it. Investing is an emotional roller coaster. Investors tend to get really euphoric at market tops, and they tend to get extremely fearful at market bottoms. Or maybe more correctly, it should be said that euphoria causes market tops, and extreme fear causes market bottoms. After all, when euphoria has set into the market, and investors have no concerns of risk, that means pretty much anyone who is going to buy stocks has already bought them, meaning there are no more buyers. There is no more demand to push the price higher. Conversely, when fear has gripped the market and all everyone can see is risk or that the world is ending, then anyone who's going to sell has probably sold already, so the selling pressure is no more and the market reverses. So it's not only that most investors get it wrong, but it almost has to be that way in order to get a reversal. It's when everyone has overloaded one side of the ship or the other that the market turns. So with that being said, let's take a look at households' positioning. The blue line on this chart shows you households' equities as a percentage of their total assets. So the higher the line, the greater the proportion of their total assets is held in stocks. Currently, we're seeing levels associated with the dot-com bubble and the peak at around 1970 before the stagflationary 70s. In this next chart, we see cash, which has been hovering near all-time lows, again associated only with the dot-com bubble. And then this third chart shows the equities to money market ratio, and this ratio exceeding even the 2000 dot-com bubble. Here we have the commodities to equities ratio, which has been a fairly cyclical measure since 1970. Commodities become worth relatively little compared to stocks at market tops, but then that reverses and they become pretty valuable relative to stocks at market bottoms or in periods of crisis. Next, I'm showing the 5-year Treasury versus 3-month Treasury spread. And what we're looking at is the other times in history where that spread has been inverted for as long as it has been inverted today. And we can see there's only been 4 other instances going back to 1965, and all of those instances coincide with a significant market top. This next chart is showing how gold relative to the S&P 500 did after 70% of the yield curve was inverted. So the blue line is showing you the S&P 500 after 70% of the yield curve first inverted. The yellow line is the gold to S&P 500 ratio during all prior times when the yield curve first inverted by 70% since 1970. The white line is the gold to S&P 500 ratio during the 1973 to 74 recession and tech bust for the subsequent 2 years after 70% of the yield curve inverted. We have now had about 70% of the yield curve inverted for over 2 months at this point. Historically, it would mean that gold has outperformed the S&P 500 for the next 2 years. This chart is showing the volatility of the S&P 500, and this just goes back a couple of years, but you can see as volatility bottoms out around 8, the market tends to experience even a near-term market top. The auto market is important to the U.S. economy, so I want to look at a couple auto loan metrics briefly. The first chart shows you the 60-day delinquency rate of both subprime and prime auto loans. Subprime now is experiencing a delinquency rate that exceeds even the 2009 peak back to about 1996 levels. The prime market's still holding up fairly well, but usually in the credit markets, it's the lowest quality that goes first and then flows up from there to the higher quality tiers. The next chart shows the spread between the national 60-month auto loan rate over the 5-year Treasury rate, and we can see that those spreads have jumped considerably back to the great financial crisis peaks. Industrial production in 4 of the world's largest economies has all dipped negative for US, Germany, UK, and Japan. Typically, you don't see them all contracting at the same time unless we are in a recession. Construction spending in the U.S. has contracted now year over year. There have been a couple small false signals throughout time, but typically when this is contracting, it's associated with recession. Within the bond market, there has been a flight to quality. The yellow line shows you the ratio of high yield or junk bonds to investment grade bonds. So the higher that line goes, it means the greater the appetite for junk bonds, and vice versa. That has rolled over the last couple of years, and the bond market tends to lead the stock market. Again, lowest quality gets impacted first. Job openings in the Midwest have been contracting, which typically has not been a good sign. And there's been a tremendous discrepancy between CEO confidence and consumer confidence. And again, here we see on this chart, when that discrepancy gets very high with consumer expectations far surpassing CEO expectations, it's typically been a precursor to recession. And here, Dr. John Hussman assembles a set of conditions that have existed near market tops in the past, and we see that those conditions are now all present again today. The conditions, when all present, are indicated by the red line on the chart, so you can see that those are commonly associated with significant market tops. Lastly, I want to talk about Fed policy itself. Taking a brief step back to the great financial crisis, they responded to that crisis by reducing interest rates to zero and expanding their balance sheet by printing trillions of dollars and injecting it into the economy. This program was called quantitative easing, and there were about 3 stages of it that ended up increasing the Fed's balance sheet to $4.5 trillion from about $800 billion at the start of the crisis. Well, over the last couple of years, the Fed has been normalizing policy, meaning they've been letting interest rates rise, and they've been trying to reduce the size of their balance sheet to get everything back to more normal levels now that the crisis is over. Well, last year in the fourth quarter, the stock market lost 20%, and the junk bond market seized up, and the Fed reversed course. So now the Fed this year has reduced interest rates 3 times and started expanding their balance sheet again. In other words, the Fed has begun taking on policy that was unprecedented up until the great financial crisis. So why are they taking emergency policy actions when the economy is supposedly strong and stable? Well, we see in this chart when the Fed reverses course, it's typically because they're concerned, and it looks like they apparently have good reason to be concerned. So whether it's slowing growth or liquidity concerns or whatever it may be, typically when the Fed starts easing again, that marks the end of a bull market and likely the presence of a recession in the near future. In summary, there are a lot of important metrics indicating we are likely much nearer a recession than is widely anticipated by the market. Most pundits seem to expect recession beyond 2020, but as we know from history, the consensus is usually wrong. Obviously, history is not a perfect predictor of the future, but it would be very naive to toss out all the lessons offered by history. Yes, markets and economies can run longer than expected, But the signs are there. Nobody in the next recession should be left wondering, but where were the signs? As you've just seen, many important metrics are indicating we are right on the cusp of a recession, if not already in one, with the potential downside risks quite large. For me, it's akin to an avalanche. When the conditions are ripe for an avalanche, as they are now, you don't need to know which snowflake will set it off. Just knowing the conditions are ripe is enough information to keep your distance and play it safe. So how do we proceed from here knowing this information? Well, the investors particularly at risk are those nearing retirement or recently retired. This is because of a concept called sequence of returns risk that I mentioned briefly in part 1 and have written about more extensively on my website. So one tool I employ for these folks are retirement projections that allow us to determine how much risk a household can afford without jeopardizing their retirement goals, even in the event of a severe bear market. We then back into the investment strategy that way, as opposed to following the risk tolerance questionnaire or some other irrelevant rule of thumb. This method helps us improve my clients' probability of remaining financially independent through good and bad markets. It reduces the chances they may have to cut back in retirement, go back to work, or forego other financial goals. For other clients, we might simply take a more conservative approach than we would in a more neutral or favorable environment. We still maintain stock exposure, but perhaps less than normal, and perhaps the bond sleeve of the portfolio is focused more on high-quality bonds with no junk bond exposure. I'm looking for a more attractive opportunity to deploy that dry powder when projected returns are much higher and metrics indicate we're near the beginning of a cycle as opposed to the end. And for still other clients, I employ a market timing strategy, which includes much more active trading. This strategy relies far less on fundamental views of the market and more heavily on technicals. Reach out to me if you'd like a complimentary review or to review any of these various approaches that might be appropriate for your unique situation. Thank you and have a great day.